All right, we got good news, bad news from the Fed. Let's start with the bad news that led the market to sell off a little bit towards the close of Jerome Powell's commentary. I kind of wish he just stopped talking because then all of a sudden the market started selling off. So the question was, why? Why did the market start selling off? What did the market hear? And what the market heard was Jerome Powell 3 times iterate that even if we stop hiking rates now, history tells us there is likely to be a softening in labor. That is still very likely. And even if we avoid a recession, we are likely to see a softening in labor. Now, I'm paraphrasing and condensing here, but that gave the market some heart palpitations. And studying a little bit on why, the answer is clear. As job openings decline, quit rates decline, and we start seeing potentially softness in labor where we see more unemployment, we now have more consumers potentially willing and able to spend on consumer goods. Consumers make up 72% of the economy. So what happens when consumers spend less money? It means there's less earnings potential for companies, and that hurts stocks. So my expectation is that some of this talk about, hey, look, we've been blessed so far that we've been able to create disinflation while unemployment has basically stayed flat. I mean, think about it. Unemployment is at the same level now as when we started hiking in March of 2022. Same level, 3.6%. So Jerome Powell's like, look, we've been blessed. We've been able to create disinflation without hurting the jobs market. But history tells us we will probably hurt the jobs market. That commentary led to some heart palpitations in the market. I expect we'll be able to see through them, but there were some heart palpitations here. That's probably the biggest bad news. I have to say, the rest of it was straight up bullish. So if you're a bear, grab your coupon code for the programs expiring tonight on Building Your Wealth. Email staff@meetkevin.com if you've got questions. Lifetime access. You pay once. It's no monthly fee. You pay once. You get lifetime access. Or drop your info at househack.com so you can be notified when my startup is ready to start accepting funds from non-accredited investors. We'll have a very small window open for people to invest. It'll probably be three to 4 weeks, and then we'll close it. Let's keep going with the more positive information from J. Powell. More positive information from J. Powell. First, starting to see signs and expecting to see more indications of rising inventory for real estate. That is a great opportunity long-term for those looking to get into real estate. Obviously, Jerome Powell was very defensive about suggesting that we've reached the terminal rate, and he actually went as far as saying we don't really want to provide forward guidance on rates. That is a complete flip-flop from what Jerome Powell said the last time, actually for the last year. For the last year, Jerome Powell's like, we want to be very transparent with the market and provide forward guidance. We are raising rates more. That was old J. Powell. New J. Powell is, hey man, look dude, we'll take it meeting by meeting and we're just not ready to give any more guidance. That is a flip-flop. When you go from, we're going to provide guidance and we're hiking, to, yeah, we don't really want to provide guidance, it's kind of a little bit of a tell that you might be getting close to the end of your hiking cycle, especially since Jerome Powell also made it clear that, hey, maybe we go 2 meetings without a hike, or we go 2 meetings with a hike and then 1 without. He kind of said both of those are possible, so you could have more time in between rate hikes. The September meeting will be very interesting, though, because we will be getting the PCE report this Friday. Then we will be getting another ECI report, the Employment Cost Index report. Then we will get 2 more jobs reports. August 4th, September 1st, mark your calendar for those Friday job reports. Then we will get 2 more CPI reports. August 10th, Lauren's birthday. September 13th. Both of those, 2 more CPI reports. Jerome Powell is really indicating that all of those in aggregate will lead to the decision to whether or not we should pause or hike again. At some point, he also mentioned, quote, given how far we've come, we can afford to be a little more patient with rate hikes. This is huge. We have not heard Jerome Powell talk about being patient at all over the last year. In fact, we generally hear about how urgent it is to get inflation down. So to hear Jerome Powell talk about patience was another bullish flip-flop. In addition to that, Jerome Powell, when it came to hitting our bingo card, told us we are at a restrictive level of rates. In fact, if you look at the chart, you could see it. But having him reiterate that we're at a restrictive level of rates was important because he says, look, as long as we're restrictive, we're actually creating more pressure on the economy. And as inflation falls, this real policy rate rises while we could be paused. In other words, we could be paused and still actually tightening the economy as inflation falls. That's because the way this is calculated is you just take the current Fed rate, 5.5 or whatever, 5.25, whatever rate you take, and you subtract the level of inflation, even if you take core inflation at 4.8, well, now you're at 0.7 for a real rate. Simple. He did seem a little bit fussier than usual, especially since the first three, Nick T, Steve Leisman from CNBC, and Jenna from the New York Times, they pummeled the crap out of Powell. And they were all kind of ganging up and nodding at each other's questions too, really trying to drill in, is this it? In terms of, are there any more rate hikes? And Powell was really defensive here. He was even asked at one point, hey, what about opportunistic disinflation? And he just wouldn't give any color, which in my opinion is a sign that maybe we agreed in the background in the meeting to go for a pause, but let's not signal that yet. Let's not signal that the Fed is in a position where if data remains the way it is, we'd be willing to pause. He did indicate also on the bingo card, so restrictive level, that was on the bingo card, and him not providing further guidance and being patient. The restrictive level aspect, very important. That was on the bingo card, we got that. This idea of two or more rate hikes, that did not come up, thankfully. That was on the bingo card, and we did not want that to come up. It did not come up, so that is bullish. He did not reiterate what he said in Portugal with Sarah Eisen, where he said, oh yeah, 2 or more rate hikes. That is fantastic. He did not mention anything about break-evens unanchoring. He did say that if they were to unanchor, obviously they would have to do a lot more. But break-even inflation rates were also on our bingo card. And that's because we have an uptrend right now on our break-even inflation rate for the 5-year. And so we're watching this. The next thing on our bingo card was core inflation, rents versus wages. We got no talk about rents here, but we did get a lot on wages. And he essentially indicated that at this moment, real wages are positive, and we want them to be positive, but that some softening is possible. And that's where we got the markets selling down a little bit about that worry about softening in the labor market. Remember how real wages work. Real wages, you want wages to be growing at about 3% with inflation at about 2%. And in that sort of dynamic, you end up with a consistent 2% inflation. It's because wages don't make up all of the inflation aspect. They just make up some of it. This is important. We multiple times had Jerome Powell talk about signs of disinflation, about how things are normalizing the way we would expect them to, that he doesn't think we would have rate cuts this year. That was an interesting kind of correction, that he said, we're not going to have rate cuts this year, I don't think, is the way he put it. I don't think it's reasonable to expect rate cuts this year either. I mean, inflation would really have to plummet. But it is clear that he's pretty comfortable with rate cuts next year. At the same time, though, you could continue running off the balance sheet. So you could have quantitative tightening via running off the balance sheet at the same time as you're cutting rates. And that all has to do with the fact that he's trying to target a real restrictive level. The more inflation falls, the more you can actually start cutting. And he finally said it. He hasn't said this before. But he finally said, because you hear people all the time, they're like, oh, well, inflation is still at 4.8% core or whatever. And he finally said, almost addressing these people, it's not appropriate to hike rates until you get to 2%. In fact, you are going to start cutting long before you get to 2% rates. We think we're going to get to 2% around 2025 or so. So he's making it clear, rate cuts are coming, but that's still going to leave us in a restrictive environment, and it could still lead to some labor market softening. That labor market softening has the market a little bit tenuous, right? In fact, I want to show you this chart because it just shows you how aggressive the market moved. We had a very clear downtrend. And usually a downtrend, like a channel down, and it wasn't a perfect channel down, so maybe that's why, but usually a channel down is going to give you a bounce. We didn't get that. And I left this gap here on purpose because I thought maybe the conference would go longer or whatever, but I left this as is. And as you can see, we actually got a straight collapse. We got this collapse because of Jerome Powell's labor market softening commentary. Now we are recovering now, But I want you to see that was a powerful moment in the conference. Paying attention to that labor market softening is something the stock market is going to care about. So that's important. We're going to be analyzing that a lot more also in the course member live streams, which hopefully you're a part of. Pay once, any of the courses, and you're in for life. Email us at staff@meetkevin.com if you want to bundle up, or you have questions, or give us a reason, why are you not joining? What can we do to make it enticing for you? Maybe there's a bundle for you. Anyway, so what's interesting about this is in the future, as we get employment reports, those might actually start becoming more important than inflation reports. So it's assume inflation continues to trend down. Now all of a sudden we look at the labor reports and go, okay, well, if labor sells off, is there a risk to stocks because labor's selling off while we're still under high rates? And the answer here, according to the stock market, is clearly yes. Jerome Powell commenting that, look, we've been able to achieve some disinflation, obviously positive, and some of this defensiveness against wanting to be able to say, hey, look, we're willing to hold here and pause here, and really putting pressure on September, suggesting, look, that September meeting is live. Obviously, we've got to now put the highlighter on the reports coming up. Again, CPI, and I'd say most important here, jobs, just based on the stock market's reaction. So, if you found this video helpful, make sure to share this. Thank you so much for joining live if you did, if you're watching the replay. Thanks so much for watching the replay. Really love y'all. We'll see y'all. I've got a lot of emails to respond to now to make sure we get all your staff@meetkevin.com emails done. And if you have not yet, go to househack.com and drop your information. You don't have to invest just by dropping your information, but if you drop your information here, at least you'll be on the notification list for when we are officially raising money. It's still going to be a 1-to-1 valuation, but I'm only going to leave that open for about 30 days because quite frankly, I think it's a steal of a deal to get into a startup where $1 equals $1. It's nearly unheard of. Usually you raise like 25 mil at like a $200 million valuation, which would be like a 1-to-8 ratio, right? This is literally $1 is $1 of cash. Pretty impressive. Obviously, the company has some nominal expenses, whether that's wire fees or whatever. But beyond that, it's 1-to-1, which is great. So, thank you so much for watching, and we'll see you in the next one. Goodbye. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by